We just finished a brutal week in the bond market. In fact, it was an outright bloodbath, and it's going to get a lot bloodier. And this is something that I have been talking about on my podcast. I've been tweeting about it on Twitter, and it seems that very few people in the financial community have had any appreciation for the risk in the bond market. I have been talking about the fact that people were underestimating not only how high bond yields were going to rise, but how quickly they were going to get there. And that is exactly what we're seeing now. This has got to be one of the worst weeks ever in the bond market. Probably the worst week that I can remember. In fact, I did read that we are on track for the worst quarter in the bond market since 1980. Now, 1980 was a very significant year because that was the year the 40-year bull market in bonds began. That bull market ended in 2020. So when it began in 1980, the prior bear market in bonds, which ended in 1980, ended with a blow-off bottom. And you had this huge sell-off in the bond market, a big capitulation. Everybody bailed out of bonds, and that marked the bottom, and that began the big bull market, which ended in 2020 when you saw that plunge in bond yields, and you saw yields below 1% on the long-term treasury bonds. And I remember at that time on this podcast, and anybody can go back and re-listen to those podcasts, but I pointed out that that looked like a blow-off top to the 40-year bull market. And I was very confident, and I declared so on my podcast, that the bull market in bonds was over and that a new bear market had begun. Well, what we're seeing now confirms the fact that we are now in a major secular bear market in bonds. And this has massive implications for investments, for the economy, because what powered the big bull market in stocks was the bull market in bonds. The fact that we were doing everything against a backdrop of ever decreasing interest rates. That's what fueled the speculation. That's what kept the money cheap. That also fueled the real estate market. Everything was built on the foundation of falling bond yields, rising bond prices. Well, all that has changed. We're now in an environment where bond prices are going to keep falling and yields are going to keep rising. That is the environment we were in during the 1970s. And the types of investments that worked out during the bond bull market did not do well during the bond bear market. What did well during the bond bear market were commodities, natural resources, gold, foreign currencies, foreign stocks, emerging markets, exactly what is going to be doing well in the future. And many of these categories are already doing well right now. It's just that Wall Street is very reluctant to recognize what's changed. In fact, most people who are on Wall Street now, working there for a living, were not around over 40 years ago. They have no understanding of an environment where interest rates are not rising. They've never operated in anything but a bond bull market. Well, they are in for a rude awakening because this bond bear is just getting started, and it's going to be brutal. It's going to be worse than the bear market of the 70s because the financial circumstances of the United States are far worse now than they were then, and the prospects for inflation are far worse, and inflation is the biggest enemy of bonds. Because remember what bonds are. Bonds are an obligation of a borrower to repay a lender a fixed interest rate over a period of time, and then at the end of that period, at the maturity, the borrower repays the lender the principal. Well, what erodes away the value of the interest payments? What erodes away the value of the principal? It's inflation. But also, as inflation rises, it pushes bond yields higher. That means bond prices fall. So if you're a bond holder and you don't want to wait till maturity, you want to get your money now and you go to sell, as rates are rising, the price that you can sell your bond at is falling and you start to lose money. In fact, year to date, the Bloomberg Global Bond Index is down 6.6% this year. And in fact, it's off 11% from its high in early January because we initially got a bit of a rally in bonds. But some people might think, well, 6.6%, that's not that big a deal. Well, first of all, you're talking about 1 quarter. So annualized 6.6%, that becomes a big number. But you have to keep in mind that when it comes to bonds, losing 6.6% in a quarter is a big loss. This is not the stock market because you have to keep the losses in perspective to what the potential profits were. If somebody bought bonds early this year, what was their expectation? Well, if you bought bonds because you wanted a 2% yield, well, you've already lost more than triple what you were hoping to gain for an entire year of owning that bond, except you lost it in 1 quarter. And also remember that bond investors are supposed to be risk adverse. They're supposed to be buying bonds because they want a safe haven. They want to have a portion of their portfolio that's lower risk. Well, they're getting clobbered in what they thought was low risk, and there's a lot more downside left in the bond market from here. We are just getting started because the yields are still ridiculously low, as I have been commenting. Let's take a look at the bond yield. So the yield on a 2-year treasury is 2.27%. What is the official inflation rate? It is 8%. So you're talking about approximately -6% yield on a 2-year. What's so enticing about that? Why would anybody want to buy a 2-year treasury when inflation is so high? Even if inflation comes down, it's not coming down that much over the next 2 years. Even if the Fed is successful in its inflation fight, which it won't be, you are guaranteed to lose purchasing power if you are dumb enough to buy a 2-year treasury. Now, the only thing dumber than buying a 2-year treasury is buying treasuries of a longer maturity. Look at the 5-year treasury. The yield there is 2.55%. I mean, why go out 5 years for an extra, 30 basis points? Take 3 more years of inflation risk? Makes no sense. Of course, what makes even less sense than a 5-year treasury is a 10-year treasury. The 10-year treasury is 2.4%. It's lower than the 5-year treasury. You get a higher yield taking less risk by buying a 5-year treasury than you would get by buying a 10-year treasury at 2.47%. Now, why is that? Why is the yield curve inverted between the 5s and the 10s? And the reason is because the bond market is correct when it sniffs the stench of recession. The bond market knows that if the Fed keeps raising rates, we are going to have a recession. And the bond market expects the next recession to look like the last one, where the Fed will immediately start cutting rates. And so future rate cuts are now being built into the yield curve. In fact, according to the data, bond investors are actually pricing in about 2 rate cuts next year. 2 25 basis point cuts sometime in 2023. So in other words, the Fed is going to continue to raise interest rates this year, maybe keep raising them early next year, and then all of a sudden the Fed's going to notice that the economy is in a recession and it's going to start cutting rates. Now, what the bond market also believes is that the recession is going to take care of inflation. That even if the rate hikes don't do it on their own, surely a U.S. economy in recession will put out the inflation fire. And that is the bet the bond market is making. In fact, I was reading an article in the New York Times yesterday, and that's exactly the point the Times was making. They said we don't have to worry about inflation. The bond market is telling us that the inflation problem is transitory and it's going to go away. Well, the bond market is wrong because the bond market simply reflects the views of the people who are in the market buying bonds. They are wrong to think that recession is going to do something about inflation. Now, they're just conditioned to believe that because over the past several cycles, that has been the case, but they don't understand that that time period is over. We are in a rising inflation environment. Just like we're in a rising interest rate environment because we're in a bear market in bonds, we are in a bull market in inflation. inflation is going to keep going up. So even if the bond market is correct on forecasting a recession, and I believe they are correct, they are incorrect to believe that the recession is going to get rid of the inflation, because let's say we do enter recession the way the bond investors believe, but we have high inflation. And the Fed says, you know what, we're in a recession, but we have to fight inflation. That's more important. So we're going to keep raising rates even though we're in recession. Well, now the bond investors are not going to get the rate relief that they expected. And so instead of rates going down because we're in recession, they keep going up because we have inflation too. We're in stagflation. And so bond prices fall. So the bond curve is wrong. Investors are wrong because they think recession means lower rates, and they're pricing that into the yield curve. But if inflation is higher and the Fed continues to fight it, then recession doesn't mean lower yields. Yields keep going up anyway. And so bond investors lose because rising rates means bond prices go down. Alternatively, if the Federal Reserve does pivot and responds to the recession by cutting rates, even though inflation is still high, then it's going to get much higher, in which case bond investors lose to inflation because the value of their bonds, the principal, erodes even faster because the Fed cuts rates to stimulate the economy, despite the fact that the inflation problem hasn't been solved. And so it exacerbates that problem. And as I said, the biggest risk for bondholders is inflation. So regardless of what the Fed does, whether it pivots or continues to fight inflation, bond investors lose. And the biggest losers of them all are going to be those holding the longest dated maturities. And that's because they're going to have to wait longer to get their principal back. And so more of that principal will be eroded away by inflation.